All right, we all know real estate is one of the best assets to hold, especially for long-term investors. In fact, over the last 20 years, it's outperformed stocks and bonds. But the problem with real estate is it takes a lot of work. You have to find the property, make an offer, negotiate, inspect, rehab, manage tenants, deal with repairs. It's just not easy. But what if there was a way to invest in real estate without all that work? Today I found one. ETF that has outperformed the S&P 500 over the last 5 years while paying a dividend yield around 3.4%. And the best part is, most investors have never heard of this ETF. So keep watching because I'm going to tell you where you can buy it, how you can use it, and why I think it's worth considering. If you like the sound of that, hit that subscribe button and turn on notifications so you don't miss out on any future uploads. All right, so let's talk about this mysterious ETF. The ETF ticker symbol is CANC and is known as the Oncology 100 Pure Play REIT Index Fund. It has a minimum investment of $1,000 and it's only available to accredited investors. Accredited investors are defined as natural persons who have individually or together with their spouse an annual income exceeding $300,000 or have made investments in the past year, either equity or debt securities exceeding $500,000 or have a net worth over $1 million excluding their primary residence. If you meet the requirements, you can buy this ETF through the OTC markets. But before you do, here are some important facts about the fund that you should know. The fund seeks to provide investment results that correspond to the total return of the MSCI US Oncology 100 Index. The index is designed to measure the equity market segment consisting of companies involved in the development, production, and distribution of cancer-related therapeutics, medical devices and diagnostics, and related products and services. In simpler terms, this fund invests in companies that are developing new ways to fight cancer. As you can see, since its inception in February of 2018, it has grown to over $46 million in assets under management and has an expense ratio of 0.59%. An expense ratio means that the fund charges a fee to manage your investment, and that fee is 0.59% of the average net assets. So if you have $10,000 invested in this fund, you would pay $59 in fees each year. Also, when you look at the top holdings, you will notice that it's concentrated in a few large companies. But the good thing about this is that these are all leaders in their space. Now let's look at the performance. As you can see, since its inception, the fund has outperformed the S&P 500 by a wide margin. However, keep in mind that past performance does not guarantee future returns. This is just one example of how an investment might perform. Your actual results may differ. In fact, when you look at the last 10 days, the fund is down almost 15%. So what is this fund down so much? Well, that's probably due to the recent volatility in the biotech sector. However, the fund is still up over 16% year to date, and since its launch, it's returned an average of 22% per year. That means if you had invested $10,000 in this fund 5 years ago, your investment would be worth over $17,000 today. That's why I said that this fund is not just MSTY or ULTY. It's a different kind of real estate investment. And speaking of dividends, the fund currently pays a dividend yield of 3.39%. Dividend yield is calculated by dividing the annual dividend payment by the current share price. So if you were to buy this fund today, you would receive a dividend payment every quarter. The fund has a history of paying dividends every quarter since its inception. And the amount of the dividend is not fixed. It can change based on the fund's performance. So that raises the question, should you buy this ETF? Well, that's really hard to say. The fund has a lot of potential, but it also comes with a lot of risk. The fund is highly concentrated in a few large companies, and the fund's performance is closely tied to the performance of those companies. In addition, the fund is very volatile. It's not for the faint of heart. On the other hand, the fund has outperformed the S&P 500 since its inception, and it pays a nice dividend yield. If you're a long-term investor with a high-risk tolerance, then this fund may be worth considering. But if you're a buy-and-hold investor, you may want to stick with something more traditional like MSTY, VTI, or SCHD. So what do you think? Will you be buying this ETF? Let me know in the comment section below. Also, please don't forget to hit that thumbs up button if you got value from this video. It helps out the channel tremendously. Thank you guys so much for watching, and we'll see you in the next video.